Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be doing a pretty quick analysis of ServiceNow stock as a growth stock, so treating it as a growth stock. This one came in by request down in the comment section of one of my other videos. If you have a stock you'd like me to take a look at on the channel, put it down in the comment section. I'll get the ticker on the whiteboard behind me. I got a bunch of requests this past week, so they're filling up pretty fast. I'm going to try to make a video almost every day. If it's a stock that's in the S&P 500 like ServiceNow, I post those on YouTube for free. The rest I post over on Patreon. And at the $5 a month tier level, you can get access to just ask me. You can request kind of any stock that's not in the S&P 500. I have a few strategies that are exclusive to the full Cyclical Investors Club service, but I can give you some context and feedback even for the stocks that might use one of those non-public strategies, which is kind of what this video is going to be, because I have a growth strategy that is exclusive to the full Cyclical Investors Club service on Seeking Alpha. But I do have a kind of a shortcut that you can kind of use, and that's what I'm going to show you here. And then also, just in general, I'm going to kind of talk about what to look for in like a growth stock. If you search my channel for Mercado Libre, ticker MELI, I did kind of a full public video talking about kind of growth stocks just like ServiceNow, where I kind of get into the details a little bit more without totally explaining my strategy. Basically, I'm just showing you what I'm looking for when it comes to like a growth stock. So just like Mercado Libre, I own ServiceNow and bought it using this strategy. So I still own it, and I'll show you where I bought it, and then I'll kind of give you like an idea how you can do a quick valuation for it, and I'll give you a kind of a rough buy price for it. So, as always, this is not individual investing advice. This is just how I analyze stocks. All right. First thing, in the fast graph here, if you look at the historical earnings, I have this maxed out, so it goes back to 2013. This dark green shaded area here, or the orange line, that represents the earnings per share, and you can see that they've risen very quickly each year, and they've never had a down year, and they even started rising a little faster in 2023. So the trend here is earnings that have been growing very fast. Now, it is a big company. It's $172 billion. This is probably the biggest company that I've purchased using just my pure growth strategy. I mean, I own like Meta and some other big companies. I guess Netflix I bought with the strategy too back in kind of mid 2002 or early 2000, like the spring of 2002 also. So I have a couple big ones, but it's mostly designed for smaller companies. But some of these are good enough and still growing fast enough where the growth is still there. So if the growth's there, then treat it like a growth business. So the question is, with earnings growing this fast, how much should we be willing to pay for it? And it's definitely more of an art than a science. But if you can just kind of keep your head about you, zoom out and think of the big picture, and not get too caught up in like media hype and things like that, you can at least take like a sound, rational approach and give yourself a little bit better chance of not paying too much, not buying kind of losers and things like that. So Now has enough of a history here where you can see that there really isn't any cyclicality to it so far. Whatever happened in, any kind of economic downturns, they were able to just grow right through it. That doesn't mean once they get a certain size that in the future, and we also haven't had like a true recession yet either. Just looking at I'm just talking about the earnings, not the stock price. So we haven't really tested this during a recession, and that's worth having some caution. But usually what I'll do is I'll look at what industry they're in. I'll kind of think about what business they're doing and how cyclical that might be. Look at peers and things like that. And often and we also had the COVID stimulus boom to consider for a lot of these stocks. So if it's something like a semiconductor or well, right now, and I got to make a video on super microcomputer, but something like that where it's kind of this immediate big rush that hasn't really been there before, a boom basically. Those are the type of things you want to be really cautious with growth stocks, because that can totally reverse and go the opposite direction. If you look at ServiceNow, that is not what it looks like so far. It looks like steady, fast growth, solid growth, earnings growth. So that sets up a situation where it's really like a buy and hold situation for me. I want to buy growth businesses when they're reasonably priced, pretty small, or at least have a lot of room to grow, and then just hold them as long as I possibly can until their growth slows. Maybe that's 10 years from now, maybe that's 20 years from now. The longer, usually the better, as long as they're growing. And I usually set a limit on these at about 20% growth per year. So if you do that with earnings, now in the full Cyclical Investors Club service, I have more metrics that I look at that go beyond earnings, but I'm going to stick with the earnings here. So just anybody that has like Fast Graphs or whatever, which I do have a 25% off affiliate link for Fast Graphs in the description. Anybody who's just using the basic version, which is all I have here with earnings, can at least get a ballpark of what to look for. And what you want is usually if you don't assume earnings will grow faster than 20% for 10 years. Sometimes, I mean, these guys have already done it, right? It does happen, but we're talking another 10 years on top of this, right? So it's really hard for businesses to do that. That's absolutely what I max out at in terms of my earnings growth assumptions. And then usually what I do is I look forward about 2 years and I say, if they can grow at like that 20% rate for the next couple years, will they be like around a 30 or a 33 PE, like right in that 30 range? If it's much more than that, I think that's just too expensive most of the time. But if you can look forward and reason, and it's not too cyclical, and you can make that 20% growth at a 30 PE, that's kind of the sweet spot, where you're going to be paying up for the stock because you're going to buy it 2 years early. Usually, I mean, these are just estimates, but this is what I'm going to show you here, what happened with my purchase. So now if we do that, you can do that on the fast graph. If we just look at, this is a good example, which is why I want to talk about it a little bit. We have 20% growth expected in 2025, 21, and 2026. All right. So that's right at that 20% level. That's what analysts are expecting. This year is expected to be 28, and we're through half the year. So, and they're on track for that. So we can go on the fast graph here, go up to the end of 2026. It's set up at a 30 PE. You can go and customize this too, but it's already at a 30 PE. So on the fast graph. So, and we can look at what price it would be at that 30 PE, which is $602.10 in order to get that 30 PE with future 2 years forward-looking earnings. And that's, again, I'm just giving a ballpark. That's the ballpark kind of that you want to aim at. So that's $602. It's now trading at $835 a share. So if it fell down to that 600 level and earnings still looked okay, earnings growth still looked okay, then that could be a spot to maybe come in and buy for the long term. So these can fluctuate. The prices can fluctuate a lot. If there's a recession or something, earnings can disappoint for a few years. But this is like the profile of the stock that you want to try to look for. Now, obviously, you can get a better profile sometimes. Usually, if it's a tech stock like this, they don't have much debt, but you can double check that. They don't. So it's just a straight up 30 PE, 20% growth. Now, they're right on the edge of like 20% earnings growth expected. So usually, I would want a little bit of a margin of safety. And maybe go instead of $600 like 500, because eventually, usually what happens is growth will fall down to like 15% for a while, instead of 20. And when that happens, this multiple that they're trading at, which is a 65 PE, will usually compress. And we never know when that's going to happen. The trick is, the longer you can go before that happens, the better off your investment's going to be. But you really, in an ideal world, you want to get those kind of 2 years in, 2 or 3 years, where things go as planned. And then once you get there, you can kind of usually feel pretty good. And if it does compress, and usually the stock price will be up enough where you'll still be doing well, even if you go through this kind of compression, multiple compression, because earnings are still growing, probably in the teens. Google grew it in the teens, like 15% for years, right? So it's not that earnings growth is bad, but you're paying a premium, and when you pay a premium, when the earnings growth shrinks a little bit, usually the stock price falls. These are all generalizations, but this is kind of the what to expect. Okay, so I bought the stock for the Cyclical Investors Club. I have November 2nd, 2022 written down. This is the 28th and 24th, so on this, in between these two. That was a big drop in price here. 361. I'm just looking at it now. Oh, I guess it wasn't that. 420, 36. Yeah. So we're somewhere in between there. It's up about 112% since then. So we can look at the dynamics I was looking at when I bought the stock. And let's see. Why didn't that shorten more? I want to go all the way to 2022. Okay, so this is roughly kind of where we were at here. So I would have seen all this growth. And like I said, I have other metrics that I use, but we're just going to look at earnings. Earnings were still growing 28% a year then. The stock was trading, probably around a 50, we'll call it a 55-ish PE ratio with 28% earnings growth. And it was well off its highs. That didn't factor too much into my choice, but it was 40% off of those kind of COVID boom highs. So it was definitely down. And a lot of those investors got flushed out. And when they did, I came in and bought. And that position, I think, is up about 112% the last time I checked. So it's done really good. But really the point that I want to make here is what's happened is, if you look at when I bought, let's just call it $400 a share or so. If at that point in time I would have looked forward 2 years at a 30 PE, it would have traded at 413.52, which is pretty close to what I paid for it, give or take. So really what happened was that 2-year forward-looking thesis played out. So now at the price I paid, I'm at a 30 PE now, even though I paid a 55 PE 2 years ago. So I'm kind of back to, I paid a premium and I'm up 100% or whatever, but because now I couldn't, if I went to buy it, I would have to pay twice as much. But what I didn't know is how long this earnings growth would last. So it actually came in a little stronger, I think, than expected when I bought it. So that's good. So I've got my 2 years in now, and let's say earnings are flat, like they really disappoint in the next couple of years. Well, this stock price will fall, but it might not fall all the way back down. It might not fall 50%, right? Which is where I bought. How much lower would have to go to where I bought it. So the longer I can go with this earnings growth being above 20%, the better off I am. And I've already banked like 100% profit. So if this keeps going, that compounding, if the earnings growth keeps going, that compounding it will really kick in down the line the longer it can go. But you really have to wait and kind of ignore. Now, this was a success story because it pretty much immediately rose a lot. But sometimes they can fall a lot first. They can fall 50, 60%. When I bought Netflix using the same strategy, I think it fell 60% in a month. And now it's up 70 or 80% or something from then. So it's a volatile strategy, but if you want to get growth stocks, you in this environment where we're not in a recession or anything, and really high quality ones, you kind of have to take the long term view and pay, what would normally be a pretty high PE, 55, and bet on growth catching up to that PE. And like I said, it's a little bit more of an art than a science, but the basic science, you need to be in the ballpark. So like I said, right now, even though I own this stock, I'm not telling anybody to go buy it. Right now, I mean, $602 would be more attractive to me, place to buy, because looking forward, that's about what it would take to get a 30 PE with 20% growth, like 2 years from now. So I wouldn't pay as much as the market's asking, but the market gives opportunity. I mean, just in May, it was down to 656, so it was pretty close. And then, you go back a year, and it was down to 550, about 560 or so. So it can be volatile, and I think investors could have an opportunity. Now, if I was going to buy this right now, I'll just tell you without showing my spreadsheet that my buy price is at 509 currently, but that will rise if they continue to grow, like earnings and revenues and profits and all that at the rate they are. So that will grow over time, but that like 509, that would be, you'd have a little bit of margin of safety in case you do get some of this compression and stuff, and it should be a pretty decent spot to buy. But like for me, like fair value is probably more like 600, assuming again all their growth keeps moving, staying above like 20% to 15% a year. All right, hopefully that helps. It's going to be a little bit different style video. I didn't even talk about their business at all, because I apply the same strategy to any business that I think can grow pretty big, that isn't super cyclical, and that's enough for me to usually go on as long as the rest of the metrics look good. So it sounds like super simple and that you need to do more work, and a person certainly can do more, but often it's more about zooming out and just thinking because some businesses can grow fast, but they're like niche businesses, so their total addressable market is pretty small. And it's hard to imagine holding those for 10 years, right? And getting 20% a year for 10 years. Now, there are some businesses, small businesses, that I can imagine, especially if they're taking business from like a larger competitor. That's good. And there's other ones too. But it's mostly about not getting caught up in the hype, like back in 2021. Because if you bought at the peak in 2021, you only made 20%. You only made 6.5% a year for the past 3 years, and that's not a successful one. And most of the stocks that you paid 120 PE for in 2021 are down like 80 or 90%. So when your successful ones only get you 6%, that's not good. So you want to avoid paying too much, even on the good ones. But you're going to probably have to pay up still. So that 30 PE, 20% growth, 2 years forward, that's a good little baseline, I think, to use. All right, if this helped at all, hit the subscribe button, hit the like button. If you have any requests, put it in the comment section. I'll see everybody later.